In venture capital, bridge rounds serve as short-term financing lifelines for startups that need extra capital between major funding rounds. Unlike traditional funding rounds, which are planned for long-term growth, bridge rounds are often strategic, urgent, or opportunistic, helping startups extend runway, reach key milestones, or navigate financial challenges. While some bridge rounds are proactive and growth-oriented, others are reactive, signaling financial distress or an inability to raise a full round at favorable terms. This makes evaluating bridge rounds a high-stakes decision for investors. A bridge round is an interim financing round designed to extend a startup's financial runway before its next major funding round, such as Series A, B, or C. It often involves existing investors reinforcing their commitment or new investors providing capital through convertible debt or safe notes. These rounds have shorter funding cycles, typically lasting between 3 and 12 months. Bridge rounds can be structured in different ways. In an equity-based approach, investors purchase shares, usually at a discounted valuation. Alternatively, convertible notes or safes allow investors to lend money that later converts into equity during a future funding round. Some startups opt for venture debt, which functions as a loan with repayment terms tied to company performance rather than equity dilution. The nature of a bridge round depends on its purpose. In a positive scenario, startups use bridge financing to seize unexpected opportunities, such as acquiring a competitor, launching a new product, or entering a new market. Some companies extend their runway to improve key metrics, like ARR, before raising the next round, ensuring a higher valuation. This type of bridge round is a strategic move that enables startups to scale faster and negotiate from a stronger position. On the other hand, bridge rounds can also signal financial distress. A company burning cash too quickly without being ready for the next round may seek interim funding to avoid a down round or compensate for missed growth milestones that deter investor confidence. In such cases, the round serves as a last resort measure rather than a growth strategy. Ultimately, bridge rounds present both risks and rewards. When used strategically, they help companies build momentum and enhance valuation. However, if they merely delay inevitable financial struggles, they can become a warning sign of deeper issues. For founders, securing a bridge round should be a deliberate and calculated decision rather than a reactive move. For investors, the critical question remains, is this a bridge to future success or a bridge to failure? Bridge rounds provide interim funding to extend a startup's financial runway before a major funding round. When used strategically, they support expansion and valuation growth. When used reactively, they can signal distress. Founders must assess whether the round positions them for success or merely delays financial trouble, while investors evaluate whether it's a stepping stone to future growth or a red flag.